For investors interested in Intel stock, its decision to develop the Foundry business could be a big reason why. Intel CEO gave Intel stock investors a lot of key information about its Foundry ambitions. So let's take a look at these developments.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Intel saying that they expect meaningful improvement in their Foundry business over time. However, it's not profitable at the moment, as they are obviously not there yet given the large upfront investment needed to build out this business. It's very capital intensive. Intel has had to put out billions of dollars in research and development, in manufacturing spending, in know-how to get this business off the ground. So as they transition from pre-EUV wafers to post-EUV wafers, that's going to be a powerful tailwind for us. Remember, Intel took a lot of heat for several years for not investing in the EUV technology from ASML. Now it has invested in this technology, and it expects that to be a tailwind in terms of the average price they'll be able to command for these newer generation products. Now they expect the blended average wafer pricing to grow 3 times faster than costs over the decade, driving significant margin expansion. Of course, if your revenue is growing 3 times faster than your costs are growing, that's creating a gap between your cost and your revenue, and that creates more profits on the bottom line, which is exactly what Intel stock investors are looking for. The CEO goes on to say that more competitive wafers, combined with their position as the only company manufacturing leading-edge wafers outside of Asia, is drawing strong interest from potential external customers. And that's going to be a strong selling point for Intel. They're going to be the only one developing and selling and manufacturing this technology outside of Asia, domestic US production. That's going to create a lot of interest from US companies who want to onshore their supply chains, who want to de-risk from Asia. As you've seen, a lot of geopolitical risk, the shipping constraints, the difficulties in bringing your products from overseas back to the United States has become more challenging. And so customers are interested in onshoring this technology, as well as certain government benefits that come along with onshoring your purchasing of your supply chain. And they signed another meaningful customer on Intel 18A, bringing their total to 6. So they've already signed 6 meaningful customers for their Foundry business, and that's accelerating. And the fact that they're getting to have this insourcing, I should say, of their technology is a big benefit, and it's helping already, as you can see with the deals being signed. Now, the Foundry market is expected to grow from 110 billion today to 240 billion by 2030. So more than doubling over the next 6 years, with almost 90% of the growth coming from the EUV nodes and advanced packaging. That's where customer demand is coming from. That's why Intel finally bit the bullet and invested in this technology, even though each one costs hundreds of millions of dollars from ASML. They decided that it was worthwhile, the risk versus reward, the return on investment was worthwhile. And I think Intel stock investors should be happy with that investment, although the stock price is not reflecting that sentiment from investors. Investors are actually not very happy with Intel. For all of 2024, the stock price is down significantly. Although one of the reasons why investors have come to dislike Intel is because of the lack of investment in developing its capabilities over several years. The underinvestment is what put Intel at a competitive disadvantage where they are today. Now they're trying to catch up, and I think that's the right strategy because they've shown that underinvestment does not pay off in this industry. So Intel saying that they already have $15 billion of external revenue embedded in their Intel Foundry target model, but that would only represent 15% of the leading edge foundry market. So how they're calculating this, they're saying So by 2030, they expect to have 15 billion in revenue from their foundry business, but 15 billion divided by 240 billion, which is the total market size, would leave them with less than 15% of the leading edge foundry market. So they're estimating a 15% market share or less than 15% market share between now and 2030. Now, some might say that's a conservative estimate, some might say that's an aggressive estimate. It remains to be seen, given that this is such a new business. The volatility of potential outcomes is quite large. So 15% could be a good midpoint to consider, but the range might be between 5% and 35% or something like that. So 15% might be a midpoint of a very wide range of potential outcomes for Intel and its foundry business over these next several years. So, as part of this restructuring of the business and developing the foundry, they formally rebranded some of their business groups, including the Programmable Solutions Group, Altera, an Intel company. So, they rebranded it to Altera, and they look forward to bringing in a private equity partner this year to help prepare that company for an IPO in the coming years. This puts Altera on a similar path as Mobileye. So that will help Intel segregate and separate some of their different business units and keep each one of these business units more focused and generate more energy and create more available time for management to focus on these core capabilities, the foundry business and the other business, because when this is splitting off and becoming a new business, that new business, when it does IPO, is going to have its own management team, its own board of directors, its own CEO, its own CFO. And so that's one part of the business that Intel's current management will not need to focus on. That's less time and energy spent on that part of the business and more focus on the foundry business and the core business, which I think is what investors look for from a management team. Now, it's similar to what they did with Mobileye. So they've already demonstrated some success in this strategy in splitting off a segment of the business into another business. And so that's overall an interesting path, but investors can be reasonably confident that Intel will do this successfully and with little disruption to the core business. So interesting stuff here from Intel in its foundry business. I think it's an interesting business for Intel to get into, given the tailwinds behind this industry, given the rising demand for artificial intelligence, and given the government incentives for this industry to be built out domestically. I think it's great timing, as I've said in previous videos, for Intel to get into this business. The benefits from the billions of dollars in government incentives reduces the risk and reduces the capital outlay needed from Intel to develop this foundry business. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.